It's 5 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Sky-high valuation. OpenAI becomes the most valuable startup at $500 billion, surging past SpaceX. Tech optimism in general. Markets shrugging off U.S. shutdown concerns as tech drives stocks to fresh highs. And the White House plans to fire federal workers this week as the government shuts down into a second day. So let's take a look at those markets because, sure, negative jobs print, albeit in the private sphere. We're not likely to get initial jobless claims today, nor durable goods data. But, we got some private data, showed negative jobs print. Why not send stocks to record highs, right? Healthcare and tech leading the way. We saw a 0.3% increase in the S&P 500 yesterday, bringing the monthly tally to a 3.5% gain. Futures pointed higher again today. Same for the Nasdaq 100. Also for the Russell 2000. The Nasdaq 100 gain in September was 5.4%. Now let's take a look at yields because this is the story. We have traders pricing in more easing. So they saw ADP and decided they know what the Fed is going to do. We saw the two-year yield drop 7 basis points yesterday in the session. We're at 354 today, 471 on the 30-year and the 10-year just above 410 again. Will we see more movement? We do get challenger job cuts today. That might give us some more indication of what's going on in the private sphere. But clearly traders think that they know what's going on. We also saw gold at a record yesterday and we're just off that record once again today. So what is that telling us? Let's get though to some individual stocks moving in today's session. For that we'll go across to London and Chloe Melly. Chloe.
Good morning, Bonnie. Let's get started with some positive movements across the AI sector this morning. After a wave of good news coming from that industry, we had OpenAI's record $500 billion valuation, as well as reports that Intel is in talks to add AMD as a customer. So there's clearly a lot of bullishness across that sector and really a momentum being driven by that fear of missing out. Moving on to Tesla, which is also up this morning in pre-market trading after the pace of sales decline is expected to slow. So there will be sales dropping in the third quarter, but perhaps not as much as dramatically as it did in the first half of the year. And that is providing some sense of relief there for those Tesla investors that have seen so much weakness recently in that stock. And finally, let's go over to Equifax, which is down this morning on the back of FICO launching a new program that allows mortgage lenders to distribute those credit scores directly to customers. That, of course, will reduce that reliance on those credit bureaus like Equifax, and that is really driving down the stock this morning.
Chloe, thank you so much. That is Chloe Melly there for us in London. And later in the show, we're going to ask why so calm. We'll be speaking with Amy Wu Silverman of RBC. She says markets aren't freaking out just yet on the government shutdown. We are in day 2 of that first government shutdown in 7 years. President Trump has taken to Truth Social to declare that Republicans must use this opportunity to, quote, clear out dead wood, waste and fraud, end quote. Vice President Vance says he didn't expect it to last long, but says firings will take place.
We are going to have to lay some people off if the shutdown continues. We don't like that. We don't necessarily want to do it, but we're going to do what we have to keep the American people's essential services continuing to run.
Meanwhile, billions of dollars earmarked for infrastructure projects in New York and hydrogen projects in California have already been frozen. Those contracts cancelled also by the White House budget director. Data also affected, with Austin Goolsbee of the Chicago Fed saying the shutdown will make the Fed's job more difficult.
The data dogs are howling because, we're not getting our usual supply of information. I will say, I consider the Bureau of Labor Statistics job data to be the absolutely best data source on jobs and statistics in the entire world. If we aren't going to have those, it's problematic. That said, the Chicago Fed has come out with some new job market indicators, and we'll be releasing them tomorrow.
Bloomberg's Paul Dobson joins us now for the market read-through. So, Paul, we're not seeing, obviously, since we're at records, much of a reaction to the showdown and the shutdown yet. How long before the tone shifts, or does it even?
Yeah, hi there, Bonnie. Good morning. So absolutely, as you say, as far as the equity market is concerned, no slowing of the momentum that we've been seeing over recent days, with that tech-driven rally continuing to push us to new highs and futures indicating more gains again for today. I think that there's a sort of indirect and then a more direct impact from the shutdown. Indirectly, of course, because we're not going to get all of that labour market information. We have to go on what we do have, which is the private sector data. That, with the surprise drop in the ADP yesterday, really convinced people that by the end of this month, the Fed will be cutting interest rates again and drove down those bond yields. Another supportive factor, incidentally, for the equity space. But on the other hand, what people are telling us is that the longer that this shutdown drags on and the more sort of it sort of reduces consumer spending, the more it sees job losses rack up in the economy as well, the more harmful it's going to be. And that may, in turn, swing the pendulum in the other direction. Of course, keeping yields maybe going down, but also having people question a little bit maybe the validity of the treasuries and the the US's sort of long-term credentials in the debt market. And then on the equity side, people worrying a little bit more about the outlook for the economy in the fourth quarter. So it could flip depending on how long it endures. But, I think that I was reading a quote earlier saying we've been through 20 shutdowns already in the US government and it's reopened every time. And there's no reason to doubt that at some point, that's going to happen again here.
Paul, Austin Goolsbee there saying this is all making the Fed's job harder. The fact that we don't get NFP and some of the other hard data that we would get out of, federal agencies. The most likely scenario is we do get that CPI data, though, in a couple of weeks. I mean, unless the shutdown lasts for longer than that. If we get hot CPI and we know there's negative jobs print and so on, what does the Fed do?
It's going to make it much more difficult for the Fed. They've definitely been leaning more on the jobs data rather than the inflation data in recent weeks. And that was what seemed to be the clincher in terms of doing what, the insurance cut, as we heard from Powell at the previous meeting. But the dot plot is indicating that more members of the Fed would see the case for further cuts, unless, there really is that sort of like storming inflation surprise that we're not really expecting and hasn't been showing through so much in the data in the meantime. If we get to the end of the month and we still have the shutdown and we're still not getting any more data, then, you could argue, if you were feeling a little bit naughty, that the Fed has the cover from the politics in order to do another cut. And, we're working on the best information that we've gotten, and so be it. And, kind of if it does result in higher inflation over time, then at least they have, sort of like a little bit of a fallback and some cover and that kind of thing. But I think, on the whole, it would take a very big inflation surprise to deter the Fed from considering the jobs data being the more important input at the moment and being minded to move towards another cut, which is what the market's pricing in.
Absolutely, and a few extra basis points of easing priced in since yesterday. Paul, thank you so much. That is Paul Dobson there. Well, tech optimism driving the market rally. OpenAI has completed a share sale that has sent its valuation up to $500 billion. That makes the owner of ChatGPT the most valuable private company in the world. For more, we're joined by Bloomberg's global head of private company coverage, Neil Callanan. Neil, OpenAI's valuation has been in the headlines several times in the past 3 years. This latest figure, though, it's particularly significant. Talk to us about that significance and the pace that OpenAI has risen to it.
Absolutely, Bonnie. Today, OpenAI became the most valuable privately held company in the world, overtaking SpaceX, Elon Musk's big rival in that space in terms of private companies. And really, it's a great indicator of just the pace of growth and investor interest in AI and the boom that's happening there at the moment. Effectively, OpenAI's valuation has tripled in a year versus earnings growth of just over 100%. So people are paying more for slower growth, which means that they believe that there's going to be exponential growth in earnings going forward. But for people who are skeptics around this, it's going to add to the evidence that perhaps we're moving from a boom into a bubble. There's been a lot of chatter in recent days about the deals being done by OpenAI and NVIDIA with related parties. People seeing echoes of the late 1990s where there was vendor financing deals done with fiber optic and cable companies, and that all went wrong. At the moment, AI is still very much a bet on the future. The user case is not fully justified at the moment, but people do obviously believe that the growth rate is such that they can make a lot of money in this.
Well, and what was so fascinating was that the company allowed $10 billion plus worth of stock for sale, and that total amount of eligible units wasn't even sold. So people were holding onto their stock even at this valuation. So more broadly then, how much has private companies' landscape changed due to AI in recent history?
It's being completely changed by this. I mean, historically, a lot of private companies, they grew over centuries. They're family-owned, they're billionaire-owned at this stage in many cases. And now you're seeing these startups that began life less than 5 years ago, in some cases, in a Tropic's case, 10 years ago in OpenAI's case, and they are becoming the biggest companies in the world with massive power and clout, yet very little revenue to back it up. And so what we're also seeing as a subset of that is now rapid growth in companies that are related to them. So in the neo-cloud space, you're seeing companies that were set up less than a year ago that couldn't win a government contract are being given deals worth billions of dollars by these bigger companies like NVIDIA and OpenAI, and that's supporting their growth as well. And those deals are often, involve equity, etc. So the bet is by the people above that these growing companies beneath will also lift their fortunes. And so you're creating a circular economy here that is completely independent of the traditional private company space, much of which was based around manufacturing, commodities, etc. This is very much a tech-driven space. So new paradigm as well.
New paradigm. Neil, thank you so much. That is Bloomberg's Neil Callanan there. Now to other top stories trending on the terminal this morning. UK Chancellor Rachel Reeves's next budget is taking shape and may include a potential freeze on income tax thresholds and changes to welfare spending. The budget is seen as a make-or-break moment for Prime Minister Keir Starmer amid frustration with the Labour Party's decline in the polls. Sources say Eric Trump has signed up as a client of Citigroup and established a trust at the bank that holds some of his father's money. The relationship started after CEO Jane Fraser reached out to congratulate President Trump on his election win in November. A Citigroup spokesperson declined to comment. The Trump organization neither responded to a request for comment either. And Chinese car makers grabbed a record 9.8% of Europe's hybrid vehicle sales in August. It's the fourth time this year that Chinese brands have reached a new peak for hybrid car share. This is all based on figures from researcher Dataforce. Chinese automakers have pivoted to selling more hybrids this year after EU officials slapped tariffs on EVs made in the country. Well, coming up, EU leaders plan to help Ukraine, but Russia is prepared to push back. We'll be live in Copenhagen next. This is Bloomberg.
There's a growing consensus among us that it's not only the European taxpayers that should pay for the support to Ukraine, but that Russia has to be held accountable. Russia is the perpetrator, it has caused the damage, and it has to be held accountable. And I think we have now a sound legal way to do this.
EU leaders meeting in Copenhagen and building momentum for a plan to loan Ukraine 140 billion euros from immobilized Russian central bank assets. Joining us live from Copenhagen is Bloomberg's Oliver Crook. So as Ursula von der Leyen said there, Ollie, a growing consensus. But is there a consensus on how that money should be used?
So that is part of the debate that we're having here among European leaders. We heard from Friedrich Merz, the Chancellor of Germany, last week out in the pages of the Financial Times, basically putting Germany's weight behind the idea that these Russian assets should be mobilized. They should be monetized in some way. This is something that the Germans had resisted for a very long time under Merz and under his predecessor, Olaf Scholz, despite pressure from the Biden administration, you'll remember, in the last few years. And of course, now that Trump basically has stopped sending money to Ukraine, the Europeans have been dealing with the very real reality that they will now have to foot the bill. And as a consequence of that, they are going through great efforts to find sort of legal ways to monetize those Russian state assets that are being held in Belgium without basically taking them. And they say that basically they have a way and a path forward to do that. The reason that that is so important is that will basically guarantee a check for about 140 billion euros for Ukraine. And the importance of that, of course, to fund the war, but it'll also send the message to Vladimir Putin that there is footing for the military expenditure within Ukraine. That is a military that is funded not for 1 year, not for 2 years, but for up to 3 years from basically Russian money. Now, there's still some debate about where that money should be spent. There are some that are saying it should be going towards reconstruction, others saying that it should go just towards military purchases, and of course some in Europe saying it should go to military purchases only of European hardware, because obviously they want to also stimulate their own economy. So that is sort of the debate, but it is significant that basically it seems that more world leaders here in Europe are coalescing behind this idea, and where there is a will on this, there certainly seems to be a way, and that may be ratified ratified in the next couple of weeks when the next EU formal meeting happens in about 3 weeks' time in Brussels.
And then where are they all standing on oil, sanctions over Russian oil revenue in particular?
Yeah, so this is another question that is also now being discussed not just by the European leaders, but also by the G7 finance ministers over the last couple of days. And we got a statement out from them yesterday and the fruits of those discussions. So obviously the G7 significant because it also includes the United States as well as many European nations and, of course, Canada, looking at ways to basically constrict the money that is going into Russia. So on the one hand, you have European leaders here trying to find the money to go to Ukraine, and the G7 leaders trying to find a way to constrict the money that is going into Russia, which is obviously critical because that is what is funding the war machine. So there are ways in which they're looking at trying to target more of the ships in the shadow fleet. But the key, Vani, will be if there is any traction behind this idea of secondary sanction on those countries like China and India that are still buying Russian crude oil, where will the pressure be exerted there? That is something that Trump put forward. Could the G7 sort of align behind that? They're having discussions about it, but they're not quite there yet.
Yeah, there's a little bit of a reluctance right now. Oliver, thank you so much. That is Oliver Crook in Copenhagen. Coming up, President Trump proposes new rules to colleges for access to federal funding. That and a look at what else is making headlines in your front page news. This is Bloomberg. Time now for your front page news. First up, ABC reporting that 2 Delta regional jets collided at low speed while taxiing at LaGuardia Airport. Video footage posted on X showed flashing emergency vehicle lights on the tarmac and damage to a jet's wing. The pilots reported damage to their windshield and at least 1 injured, according to the air traffic control audio. Next up, the Journal reports that the Trump administration wants colleges to sign an agreement in exchange for preferential access to federal funds. The terms include that schools ban the use of race and sex in hiring and admissions, as well as freeze tuition for 5 years. The White House sent letters inviting an initial round of 9 universities to sign on to the agreement. And on the New York Times front page, the Trump administration announcing that it would withhold $18 billion in federal funds previously awarded to New York City. The expansion of the 2nd Avenue subway line and new rail tunnels under the Hudson River will be held up. Those are already underway, we should mention. The freeze is the largest yet in New York. Well, now let's head over to Singapore. Robinhood co-founder and CEO Vlad Tenev says that tokenization of assets will rewire the financial system. He spoke with Bloomberg's Haslinda Amin earlier from the sidelines of Token 2049, Asia's flagship digital asset conference.
I think tokenization is a freight train, and it'll eat the entire financial system. But I think it'll be a very positive thing. I think that the financial system will be largely willing to go through this transition. I think what you're going to see is outside of the U.S., where there's a little bit less legacy infrastructure, and the big incumbents can consider it net new business. You'll see it, getting market dominance first, and then it'll be somewhat backported. You can see this in Robinhood's business. We launched stock tokens in the EU, which are tokenized versions of several hundred top names. We also introduced and demonstrated tokenization of OpenAI and SpaceX private companies. And as soon as that happened, we started getting lots of calls, not just from companies that wanted to know how to get involved, but also from large established counterparties, market makers, institutions. And they were asking us, they were like, wait a minute, how do we get involved? Can we provide liquidity here? Can we plug into your European offering? So I'm very optimistic that this is going to be a big shift, and we're at the very beginning of it.
You talk about a big shift, and we have to throw it out there. It's not just about stocks. It could be about bonds, real estate. And today we ran a story on the Bloomberg about how Zach Witkoff is talking possibly about tokenizing Trump's real estate. How realistic is that? How soon might that happen?
Well, I'll tell you, it's not a technology barrier. We have the capability to tokenize all sorts of real-world assets. You saw that in our European announcement. We could tokenize privates. Obviously, we're live with tokenized versions of public equities. Real estate, art, all of these assets that have been typically the domain of high net worth individuals, they've been illiquid, they've had high fees for transactions. I think you'll see those being tokenized and being packaged up and made available to the mass market. And I think real estate's a big opportunity. I think it's smart that they're aggressively pursuing that because everyone wants access to high quality real estate, particularly the mass market.
But isn't it true real estate is actually more complex? I mean, they tried this before. It hasn't really worked.
It has some similarities to a private company, actually. If you think about what a real estate investment looks like, you create a corporation. Using that corporation, you acquire some assets. It has some costs, which you want to minimize as much as possible. Maintenance. It has revenues like rent, receivables, or depending on how you use it. So if you can tokenize a private company, that same technology can actually be used to tokenize real estate.
It was Robinhood CEO Vlad Tenev speaking to Bloomberg's Haslinda Amin. Do stay with us. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Sky-high valuation, OpenAI becomes the most valued startup at $500 billion, surging past SpaceX. Tech optimism, markets shrugging off U.S. shutdown concerns as tech drives stocks to fresh highs. And the White House plans to fire federal workers this week as the government shutdown stretches into a second day. And we weren't kidding. We saw records yesterday on most of the major benchmarks, and futures look to be pointed higher once again today. This all because we got negative jobs, albeit in the private sector, sure. But we don't get jobless claims today either. Neither do we get final readings on durable goods orders, factory orders. We do, though, have enough, it would seem, to have traders adding to easing bets. The S&P ended September with a 3.5% gain. The Nasdaq 100 was up 5.4% in the month. Let's look at yields because we are looking at them moving lower. In fact, the 2-year dropped 7 basis points after we got that ADP negative print yesterday. The benchmark 10-year was down 5 points, and we have them roughly at around the same levels today, 3.53 on the 2-year, the 10-year at 4.0923. We do get challenger job cuts a little bit later on. And I do want to bring you this headline. The EU is to propose doubling the tariff rate on steel imports to 50%. Once again, keep an eye on steel stocks today. The EU is going to propose doubling the tariff rate on steel imports to 50%. All right, let's get to some individual stocks to watch now. Over to London and Chloe Melly. Chloe.
Good morning. So AI-related companies are up this morning on the back of a wave of really good news from across that industry. So we had, of course, OpenAI's $500 billion valuation that you mentioned, as well as reports that Intel is in talks to add AMD as a customer. So there seems to be a lot of momentum in that industry, and investors seemingly not too worried yet about that AI bubble potentially. Moving on to Tesla, where the pace of sales decline is expected to slow. So that is driving the shares up and providing some sense of relief for those Tesla investors after quite a lot of weakness in that stock. And finally, let's move over to Equifax, which is down this morning after FICO launched a program that will allow mortgage lenders to directly calculate and distribute credit scores to customers. So that will, of course, reduce that reliance on credit bureaus like Equifax. And this is really driving the shares lower this morning for Equifax.
Yeah, it's a fascinating story. Chloe, thank you so much. That is Chloe Melly there. Amy Silverman of RBC says investors have been, quote unquote, angsty for a while. She writes this: the markets have not started freaking out yet as the government shuts down, but I do think they will if this becomes a protracted fight. I'm pleased to say now that Amy Silverman joins us. She is head of derivative strategy at RBC Capital Markets. Amy, what will it take? I mean, it seems like every time we get a tech headline like the OpenAI valuation or somebody doing a partnership with somebody else, it just shunts everything else to the sidelines. Do we need for these other tech headlines to go away in order for the market to feel that there's actually a government shutdown?
Yeah, perhaps, or perhaps, Bonnie, it's just that the impacts are quite early right now. We haven't felt anything yet. I think even personally, if you start going through that TSA line and it's taking a lot longer, then it starts to hit the market and investor psyche a little bit more. Look, we're really only in day one of this. We've seen government shutdowns, specifically going back to December 2018 to January 2019. That was quite protracted. And then you did see a move both in the market and volatility. We're certainly not there yet, but I do think that could create some potholes if it becomes lengthened in time.
Yeah, the VIX has crawled up between 16, 17. Is that an appropriate level for the level of risk that's out there right now? What is the term structure of the VIX curve telling us?
Yeah, two great questions. The first is, I think this is a big source of debate in our world. So a 16, 17 wicks, it's above long-term averages, but it is still relatively sanguine. I think most people think of that psychological 20 level as starting to get angsty, if you will. But at the same time, you do have relative steepness in term structure. That's something we saw almost immediately heading out of Liberation Day 2. And just to translate, that just means that future concerns are greater when you look at them on a normalized basis than they are now. And it's sort of reflecting the fact that there are a lot of can kicking, certainly both from the government side and the market side, but it doesn't mean that you won't hit a reckoning at some point in time.
Yeah, we were just looking at a chart which showed us where the VIX was the last time that we had a shutdown 7 years ago, and it was, close to 36. That said, the S&P had dropped 18% to that point, and it does seem like we do get S&P support whenever there's a VIX spike. Now, I want to ask you, we have gold and stocks pretty much at records. Is that a market that's contradicting itself, or are these two very different cohorts of investors here?
No, I think that's actually, when I think about the rally, a lot of investors say to me, it feels like a reluctant rally, meaning they feel like they must participate. And we've written about this, essentially this idea that right now, this right tail, this FOMO that you get in the market where the concentration is so high in benchmarks that you as an investor must be in the market. When you think back to gold, it kind of shows you that it is to some degree reluctant, and to some degree people are thinking about the left tail. They've just chosen to express it in a different vehicle, because when you look at something like the S&P, because it's beholden again to that one day we'll get some OpenAI news or we'll get some AI tech theme news and it can just continue to rise up. You have to prosecute that right tail in a different way than you have in the past.
Who is hedging right now, Amy, and what kinds of hedges are they putting on? It doesn't seem like there's a lot of macro hedging going on, but there must be.
So the short answer is a lot of folks, when we kind of left Liberation Day and we had that spike up, they were still pretty skeptical. You saw that in term structure. You did see people hedge. Now, essentially what happened is after the Fed spoke and they did their first rate cut, a lot of those hedges rolled off and they have not been reinitiated. One of the reasons is, Vonnie, people just didn't make money on those previous hedges. The market has a short-term memory and people don't like remembering that they paid premium and watched it burn away. So the answer to your question is not many people are hedging now, because a lot of hedges that were placed didn't make any money and they're reluctant to do it again. I think sometimes it actually takes a drawdown first to see more hedges come back into the market.
It's funny, you tell this anecdote in your notes that, you speak to investors a lot, obviously, and when you speak to more than 30 at a time, you ask by a show of hands who thinks the market will be up by year end. And even though they've all been bearish throughout your meeting, the preponderance of hands goes right up, right? So there's some kind of a dislocation here. If we see any kind of catalyst that starts to poke at this market, will we see a complete capitulation?
Not necessarily complete capitulation, but I do think the velocity is something that you have to watch out for, because that's exactly right. It's one of my favorite anecdotes, because anytime I get into a room where that end sample size is fairly large, I've got to take my poll. And again, these people aren't happy about it. They feel like they have kind of under participated, but they do think the same thing. And so I think if you start to get either, this could be earnings or could be a protracted delay, you finally get that drawdown that, I don't know if you remember, everyone was talking about this drawdown that we're definitely going to get because of seasonality in September, October. Where is it? I don't know. I don't see it yet. But, the idea that expectation is still there, I think, can place that velocity a lot quicker than we expect.
Amy, are there any spots you see where downside protection is cheap, or maybe even cheap to the point of being mispriced?
Yeah, I think a lot of just your indices, your S&P, your Qs, your IWM, they're all relatively inexpensive relative to history. That often happens when you've had the rally and then a lot of these hedges get rolled off and they don't get replaced. So just simple things like that. The second thing I would say is when you think about the left tail as what people typically talk about downside versus the right tail, that spread is becoming larger, especially in areas where it's like those big themes like mega cap tech versus something like small cap. For example, we've continued to see those volatility spreads widen because people also want to play these themes of valuation being too expensive in one versus the other. And so there are a lot of pockets of opportunity. The question is, do we keep riding this momentum wave or do people finally get to take advantage of it?
Yeah, I mean, to the extent that we've seen a run-up, what is it responding to? Is it responding to a Fed rate path uncertainty, Fed independence being perhaps questioned, the rally going on too long, Amy? And where are you seeing protection being bought?
Yeah, I'd say two things. I'd say first, when you see protection being bought in the indices, a lot of time what happens is you just get that capitulation. So what we're actually seeing people do is instead of owning something, for instance, like owning the small cap rally, they're renting it. So what they're doing is they're buying call spreads, for instance, in IWM. And so this is a way of an investor saying, look, if we believe that at some point you're going to get a breadth widening, which they think is healthy, they're still not ready to kind of put all their chips in that basket because they continue to see that concentration rally in names like mega cap tech. And so they're going to rent rallies in other places as opposed to putting on protection in names where there are concentration risks. Because again, that FOMO makes it very difficult when you're at the end of the year and the indices have run and you haven't. So we're actually seeing these right tail placements as a way to proxy instead of using downside protection in many places.
Amy, cannot wait for the next update. Much appreciate your time this morning. That's Amy Wu Silverman of RBC. Coming up, billions withheld from the coasts and federal layoffs loom. It's day 2 of the government shutdown. More next. This is Bloomberg.
We are going to have to lay some people off if the shutdown continues. We don't like that. We don't necessarily want to do it, but we're going to do what we have to keep the American people's essential services continuing to run.
The U.S. government shutdown entering a second day. President Trump has taken to Truth Social to declare that Republicans must use this opportunity to, quote, clear out dead wood, waste and fraud. Bloomberg's John Harney joins us now from D.C. John, what do we know about the government's scope to actually lay off federal workers?
Well, President Trump has clearly gone on the offense here. He indicated that some of the workers who've been furloughed may be out of work, put out of work permanently during this shutdown. And he and others in the administration have said that this will give them an opportunity to dismiss perhaps hundreds of thousands of federal workers. Now, Republicans have said, some even publicly, that this may not be a great idea, as the Doge campaign by Elon Musk earlier this year, in which thousands of federal workers were dismissed, agencies were, budgets were slashed, that proved to be rather unpopular with many voters.
Yeah, I mean, the press secretary, Carolyn Levitt, said that we'd see these layoffs begin within 2 days, and that would, take us to Friday. Meanwhile, New York and the West Coast are seeing billions in funding either frozen or pulled. Can you give us some more details, John?
Well, the two projects were held up with our federal money was cut off, at least temporarily. Now, those projects both happen to be in New York, the home states of Senator Chuck Schumer, the minority leader in the Senate, and Hakeem Jeffries, the minority leader in the House. The projects in question, the extension of the Second Avenue subway in Manhattan, and the rail tunnel under the Hudson River between New York and New Jersey. Now, nobody seems to have, perhaps, I don't know how much consideration went into this, but this project is important to New Jersey. The rail project is important to New Jersey as well as New York. And Jack Ciattarelli, I hope I'm not pronouncing that right, the Republican candidate for governor, is trying to become the first Republican governor in New Jersey since Chris Christie. And that's a very Democratic state. So we'll see how that goes over politically in New Jersey.
Certainly the screws are being turned. Bloomberg Washington editor John Harney, thank you so much. Well, markets shrugging off shutdown-related concerns as tech drives stocks higher this morning. Now, OpenAI is driving that optimism with a new valuation. It's eclipsed the $500 billion mark now after the firm completed a share sale. It makes the owner of ChatGPT the world's most valuable private company. For more, we're joined by Bloomberg's global head of private company coverage, Neil Callanan. So, Neil, OpenAI's valuation, it's been in the headlines several times in the past 3 years. How significant is this latest figure and the pace that we've seen OpenAI rise to it?
Yeah, it's huge news, Vonnie. OpenAI is now the most valuable private company in the world. It overtakes Elon Musk's SpaceX, continuing that tension between Sam Altman and Elon Musk. But also, it's just a sign of just how much interest there is in AI at the moment and how much demand from capital there is. So effectively, OpenAI's valuation has more than trebled in the space of a year versus revenue growth, which is annualized at just over 100% at the moment. So effectively, people are willing to pay more for less earnings growth. Which just shows the kind of exponential nature of what they think is to come. SoftBank among those being investors in the latest round. And these people are basically playing bets that AI is going to be the dominant industry over the next 25 years. For those who are a bit more skeptical, this is going to add to that evidence. They're worried that the boom is turning into a bubble, and we're going to see more deals like this going forward, and that's going to, we're going to see whether these deals will lead to actual revenue, which will justify the valuations and the growth that's there at the moment.
Yeah, but not even everybody sold their shares, which was very interesting. How much has the private company's landscape changed due to AI in recent history?
Yeah, it's a huge shift, a paradigm shift as it were, because while companies have been staying private for longer in recent years, Stripe is a good example of that. Effectively, all these companies have emerged in the last 10 years, and suddenly they are the biggest companies in the world, or at least some of the biggest companies in the world. So OpenAI and Anthropic, for instance, are now 2 of the 5 biggest privately held companies in the world. And that shift, it just shows that there's going to be an ongoing trend to stay away from listings. These companies don't want regulatory oversight. They don't want to have to publish earnings. They don't want to have to answer to short-term shareholders. They're taking a long-term view on their spending. And that's part of a wider shift. The number of US publicly traded companies has fallen about 50% since 1996. AI is just merely an accelerant on that trend, and it is a huge trend. We're starting to see companies, they might have revenue of 0 to 20 million at the moment, but in 2-3 years' time, they could be some of the biggest companies and some of the most powerful companies in the world.
Fascinating. Neil, you're going to cover it all for us. That is Bloomberg's Neil Callanan. Thank you. Well, one stock we're keeping an eye on, Tesla, as the EV maker is scheduled to report third quarter deliveries. For more, I'm joined by Bloomberg's Craig Trudell, who leads our global autos coverage. So, Craig, what can we expect from Tesla's third quarter sales numbers?
Yeah, we look at the consensus estimate, and it's for a small decline, about a 5% drop. But I think many analysts, just as the quarter was coming to a close, were a little bit more bullish than that. So there's some possibility that we see a slight uptick actually year over year. And of course, that would be in keeping with a trend we saw yesterday with a lot of manufacturers coming out with really positive sales results for their EVs in the U.S., where consumers were trying to take advantage of the consumer tax credit for EV purchases before that was phased out at the end of September. So going forward, we're not going to have that big sort of tailwind for EV sales in the U.S. And so the big question is, putting aside whether or not we see a small increase in Tesla quarterly sales for the third quarter, just how much of an impact is that taking away of incentives going to have on Tesla in the quarters to come? We've heard Elon Musk talk about some possibility that Tesla could be in for a few rough quarters going forward.
Yeah, well, it's interesting. Year over year, the stock is up 84%, but just this year alone, only up 13%. And some of that has come just recently since Musk renewed his focus on the company after a little bit of a diversion. So does it really matter what the delivery numbers are?
It's honestly a good question. I think there's been not a whole lot of attention paid to sort of the fundamentals of this company. It's more a narrative of, Musk sort of putting aside politics, and at least that's the narrative. I think he's still sort of very, very active on X and fighting the culture wars. And yet, the fact that his board has arranged this pay policy and put out a lot of ambitious targets, I think that was, sort of pivotal for these shares. And I also think, the emphasis that the company is putting on, the shiny objects in the future, the humanoid robots, robo-taxi services, those sorts of things are what sort of get the bulls animated, as opposed to the sort of boring business of just selling cars.
Will it be very affected by, China's pivot to hybrids, particularly now that those EV credits are going away?
Yeah, I think we're seeing, particularly here in Europe, the Chinese manufacturers getting huge traction with their hybrids. And we saw just this past month them setting a record in terms of their share of the hybrid market. I think, in the U.S. as well, we're seeing, even before the Trump administration sort of took away a lot of the support for electric vehicles, we weren't seeing this sort of huge uptick in sales that we maybe were hoping for, would be a sort of a byproduct of the Biden administration's level of support for this industry. So, a much greater strength in terms of even conventional hybrids without a plug. The likes of Toyota have really been benefiting from that in the U.S. We may see more of a trend, sort of across the industry where we're hearing a lot of manufacturers putting more emphasis on that because of the pushback that we're seeing at the showroom level of consumers just not being ready to make that full jump yet to fully electric.
Yeah, exactly. Craig, thank you so much. Looking forward to those numbers a little later this morning. That is Bloomberg's Craig Trudell. Coming up, we'll get you set up for your trading day, so stay with us. This is Bloomberg. First up, Tesla today set to report its third quarter sales data. Now, we don't get jobless claims data as the US government shutdown enters a second day. We won't get those final durable goods orders or anything like that. We will get challenger job cuts, though, and we do get some Fed speak from Dallas Fed President Lori Logan at 10:30 a.m. Eastern. Let's take a look at some of the pre-market movers. Obviously, chip makers higher after the industry saw its market value soar, adding $200 billion in a global rally on AI optimism. Tesla higher by 1.4% ahead of that latest round of deliveries data. And Equifax, this is a really interesting one, dropping more than 11% pre-market as FICO says it's starting a direct licensing program, which could mean that Equifax wouldn't be as important a player in the system anymore. Let's take a look at the macro environment as we enter day 2 of a shutdown. We have futures pointed higher after a great month in September. We're kicking things off in October on a nice note. We do have a weaker US dollar, though, and the 10-year yield under 4.10. That's it for Bloomberg Brief. Surveillance continues the conversation. This is Bloomberg.